Okay, good morning, everybody, and welcome to Experian's quarterly business credit review for Q4 2023. My name's Gary Stockton. I work here in marketing at Experian with Brody. Before we get underway, I want to mention just a couple of things. If you would like to follow along, we've dropped a PDF of the slides in the handouts area. We'll also include a link to the slides in our follow-up emails. During today's webinar, we'll be discussing key findings from the latest Experian and Oxford Economics Main Street report for Q4 2023. You should all receive a copy of that report from Experian announcing the release. If not, our follow-up will include it if you do not already have a copy of the latest report. Our presenters today are Brody Oldham, Vice President of Commercial Data Science for Experian, and Michael Pierce, Lead US Economist with Oxford Economics. Brody heads a team of statistical consultants, scientists, modelers, and engineers delivering advanced analytics solutions, services, and actionable data visualizations to clients. He also represents Experian as a speaker and writer on credit market trends. Michael is a key part of the US macro team at Oxford Economics, responsible for forecasting the US economy, writing analysis on thematic topics with a particular focus on the consumer outlook and Federal Reserve policy. He speaks and presents regularly to clients of Oxford Economics, and his work is frequently quoted in national and international media. We encourage you, of course, to submit those questions using the Q&A applet in the tool panel. We'll try to leave some time at the end to answer them. If not, they will be routed to our experts and responded to following today's webinar. And now I would like to turn things over to Michael from Oxford Economics. Michael.
Thank you very much, Gary. The good news is that the outlook I'm going to present today is certainly somewhat brighter than we were talking about 3 months ago. And really, the state of the economy as we're reaching towards the end of the first quarter here is that 2024 is shaping up to be another year of solid economic growth, if not booming economic growth, certainly solid. So on my first slide, I show that GDP growth, our expectation is the economy will grow about 2.3% this year. So it's a slowdown from the 2.5% rate that we saw last year, but that's still a pretty decent pace, even if it's not going to set the world alight. So really the key drivers of continued solid growth are simply that a lot of the headwinds that we've seen over the past few years from tighter monetary policy and rising interest rates, a lot of the peak drag from that now appears to be in the past. As that fades and as we turn more towards interest rate cuts from the Fed, we think there's going to be a tailwind to the economy from some of these drags beginning to reverse. At the same time, I think it's very important to the overall economic outlook to consider what's happening with inflation. Just to look back at how much progress there has been after inflation peaked at over 9% a few years ago. We're now down to headline inflation and core inflation being just below 3% on the Fed's most closely watched measures. And we think that we're going to get some further progress on disinflation this year. So we expect core inflation to continue ticking down and reach closer to the Fed's 2% target by the end of this year. That's quite important because that is going to be the key thing that the Federal Reserve are looking for when they're considering when to cut interest rates. We think they're going to take a very cautious approach because, of course, we've still got a very strong economy, so there's no pressing need to cut rates. But as inflation comes down, we do think that they'll be able to start to loosen policy. We've got our first rate cut in our forecasts for May, and we think the Fed will cut rates 3 times this year. So relatively slow pace of cutting from what we've seen in the past, but certainly enough to provide a little bit of optimism about the economy. So my next slide, as I said, one of the key things informing our outlook is just that the peak drag that we've seen from the rapid increase in interest rates over the past few years does now seem to be behind us. That big tightening in financial conditions that we saw over the last couple of years has begun to reverse as financial markets have begun to price in more some loosening from the Federal Reserve. That's consistent with a lot of rate-sensitive parts of the economy beginning to rebound. I think we've already started to see some of this in the housing market. where we've seen a bit more optimism driven by falling mortgage rates. That's translated into a bit of a bump up in home sales, but also driven a bit of a turnaround in home builder sentiment. Certainly, if we look at single family housing starts, those have turned around pretty significantly over the past few months. As we get closer to Fed rate cuts, those mortgage rates should continue to trend down, and I think that's going to help drive a gradual normalization in activity in the housing market. But the emphasis there obviously is on gradual. Now, one big question we tend to get is, well, the Fed raised interest rates relatively aggressively. How come we didn't see a bigger impact from monetary tightening on the economy over the past few years? Many forecasters a year, 2 years ago were forecasting the economy would fall into an outright recession, and that's proven not to be the case. The economy's remained relatively resilient. I think that does mask, when we look closer in detail at the figures, we have seen a big impact from tighter monetary policy. As we said, we've seen a big decline in housing market activity. Mortgage applications reached their lowest level since the early 1990s. We've also seen that in business equipment investment, businesses spending a lot less money investing in new equipment. That's fallen for the best part of a year now. And so what we should see as some of that tightness goes away, and the other part of this, of course, is the tightening in lending standards that we saw from banks over the past year. As that begins to reverse, we should see businesses move into a more aggressive approach into investing more in equipment, and this turnaround in the housing market. I do think that will drive some rebound in rate-sensitive activity. But as to why the economy's remained relatively resilient, well, I think that weakness that we've talked about in rate-sensitive parts of the economy has been offset by strength elsewhere. One of those, of course, has been fiscal policy, which has remained relatively generous, relatively stimulative. The US is still running relatively large budget deficits. This year, the budget deficit was set to come down, but I think the risks there are that fiscal policy may be a bit more supportive heading into the election. We still have the threat of a government shutdown lingering over us, so there's still some downside risk in the near term. But we've also seen the House pass a bipartisan tax deal, which would extend the child tax credit and would extend the range of business tax benefits, all of which add up to about 0.5% of GDP in terms of stimulus this year. So I think certainly the outlook for fiscal policies looking a little bit more supportive this year, and that's certainly been one factor which has helped offset some of the monetary tightening we've seen over the past few years. But of course, the other big part of the US economy, we can't really talk about the strength of the economy without it, is of course the consumer. On my next slide, I show, obviously, a few years ago, the peak of inflation was a really rough time for US consumers. We saw real wages declining across the board just because the price of goods, food, energy was rising far more rapidly than wages. But the good news is that situation has now largely reversed. We're now seeing substantial real wage gains across the income spectrum. Interestingly, when we break this down, it's those at the lowest end of the income spectrum have benefited the most from falling inflation over the past few years. That's a combination of stronger wage growth for those at lower and more moderate incomes, but it also reflects the fact that the prices of necessities has fallen the fastest. So we've seen a big slowdown in inflation for food and a big slowdown in inflation for energy. So it doesn't mean the prices have gone down, but they're no longer rising at such a rapid pace, and wages are rising more rapidly than those prices are now. So it doesn't explain, obviously, still a reason for sentiment being pretty depressed, because people are still reeling from this period of this squeeze on real incomes. But certainly the outlook looking forward, and particularly the outlook for spending, is more positive because we've got those real wage gains, and those look set to persist. And really a large part of that is down to the continued resilience of the labour market. The US economy is still generating hundreds of thousands of jobs each month. The unemployment rate at less than 4% is historically low, and we're still seeing wage gains in the region of around 4%. for the average US employee. So still a substantial source of strength, and we certainly expect that strength to be sustained over the course of the coming year, even if the pace of those job gains begins to come down a little bit. Now, of course, the other part of the consumer is not just that incomes are now rising at a steady pace, but the fact that consumers have been able to reduce their saving as well, I think, has been key in supporting the economy and the economic outlook over the past few years, and remains a source of strength, I think, looking into the future. And really what we're talking about this is just the position of households' balance sheets look very strong, and pretty much across the board. So, relative to before the pandemic, households' net worth has increased substantially. A lot of that, the bulk of those gains has been driven by the big increase in house prices, which has generated a substantial gain in homeowners' net worth. And the interesting thing is that hasn't been mirrored by a rise in debt. So debt levels for the average consumer have actually declined over the past few years, as consumers have been able to use their excess savings from the pandemic to help pay down debt. We've also seen forbearance in a number of areas, particularly student loan forbearance, which has helped reduce the value of those debts in real terms relative to household incomes. So households as a whole appear to be well placed to continue spending and to continue saving a smaller share of their income into the future. So that means the outlook for consumer spending overall looks relatively solid. Now, that's not to say that there aren't pockets of risk, but I would describe those as mostly pockets of risk rather than a substantial threat to the overall recovery. And of course, those that don't own their own home haven't shared in this real estate building real estate wealth over the past few years, and we are seeing signs of distress among more vulnerable groups, and I think that's reflected in a pickup in credit card delinquencies. But this isn't the sort of thing which is going to topple the overall consumer recovery. As long as the labour market remains solid, we should continue to see continued strength in consumer spending, and really that will drive the overall economic outlook. It's difficult to see the US economy falling into a recession if the consumer remains strong. So I mentioned that one of the biggest parts of the strong consumer story was the strength of the labour market. On my next slide, I really highlight the strength of job gains that we've seen over the past year. Really, there's everyone's been looking for signs that the economy is slowing, that we're starting to see that weakness filter through into weaker payroll gains. But there hasn't really been a substantial slowdown in payroll growth over the past 12 months. The economy is still creating close to 300,000 jobs per month, which is substantially above the pre-pandemic pace of closer to 170,000. But that strength in the labour market has still been accompanied by labour demand and labour supply coming into better balance. Now, that's important because it's that balance between demand and supply which is driving wage growth, which is responsible for a lot of the inflation that we're seeing in the economy. So the Fed would like to see labour demand and supply come into better balance and wage growth to fall to rates more closely aligned with its 2% inflation target. Now, I think the interesting thing is that this has continued to proceed even as the labour markets remained relatively strong. So I think what we're seeing is a big supply side influence coming in from the labour market. These job gains are being met by increased supply of workers. Over the past year, that's been both a combination of elevated levels of immigration, but it's also been a story of more people coming into the labour force, perhaps tempted by the prospect of higher wages, but also I think a big part of that has been more women coming into the labour force, perhaps as it's becoming employers are offering more flexible terms which enable more mothers to combine looking after children with work responsibilities. That supply side help has meant that we've still seen this rebalancing between labour demand and supply. We see that in the right-hand chart here, where the quits rate, measuring how frequently people are quitting their job, that's a good measure of kind of how much excess heat there is in this labour market, how strong labour demand is relative to supply. Feeds into how confident people are in that they'll find a new job elsewhere with better terms, so that they're more likely to voluntarily quit their current workplace. And we see the trend there is still firmly downwards. So even though we've still got a strong labour market, it still seems to be coming into better balance. That should help wage growth continue to slide down from its current rates of 4–4.5%, closer to 3.5%. Now that 3.5% wage growth really is the Goldilocks level that the Fed would like to see. That's because it's got a 2% inflation target, and productivity growth in the US, so how much more the average US worker does each year, has typically risen by around 1.5%. So 1.5% productivity plus 2% inflation, around 3.5% for wage growth is consistent over the longer term with the Fed's 2% target. So all the evidence we're seeing on the labour market front is that we should be set for a continued disinflation towards the Fed's 2% target. And on my next slide, I'll show this is broadly what we've seen over the past year. Over the course of the second half of last year, core inflation fell very substantially. Not only did we're used to thinking of inflation as a year-over-year rate, so how prices are now compared to a year ago, but we can look at on a higher frequency to get a sense of the shorter running trends. So when we do that on a 3 or a 6 month annualized basis, just looking at inflation over the last 3 or the last 6 months, that's actually been running much closer to the Fed's 2% target for most of the past year. So essentially, a lot of this disinflation that we're expected to see has already happened, and we now just need a continuation of the recent trend. So core inflation kind of remaining around 2%. Now, what we saw in January was a big upward surprise in inflation. That was a little surprising, but there's a lot of issues with the data. There's a lot of noise. There's a lot of one-offs that occur, particularly in January at the start of the year. Really, we want to focus on these kind of longer running trends. And like I say, with the disinflation coming from the labour market, we think we're relatively confident that its core inflation will remain on a downward trend over the next 6 to 12 months. And that's really key where the disinflation is coming from as well. Most of the downward surprise in inflation we've seen over the past 6 months has been in these core services, which are much more reflective of domestic wage trends. Services businesses, most of their costs are of the employees that they're hiring. So the deceleration in wage growth and the trends we see there are the most closely watched by the Fed, because they're most indicative of where these stickier categories of inflation are heading. Things like food, energy prices are more fickle. They can bounce around a lot, more influenced by global trends. It's really these underlying slower moving categories that the Fed is focused on and which their monetary policy can most closely affect. With that inflation remaining on a steady downward trend, I still think it's a good bet that the Fed is going to be cutting interest rates this year. On my next slide, I show that really the Fed can afford to be cautious this time around. We're used to the Fed operating in this regime where they take the escalator up and the elevator down. So they tend to be relatively cautious when they're tightening monetary policy. They want to slowly take some of the heat out of the economy, but they're wary of pushing the economy into recession. And then when they're cutting interest rates, it's typically in response to sudden weakness in the economy. They're really worried that a recession is developing. They cut interest rates quickly to support the economy. That tends to be the historical pattern. This time around has been completely different. Obviously, the last few years, the Fed was raising rates, especially rapidly, as they realized they were badly behind the curve in terms of combating inflation. And now I think the outlook is such that we've got a relatively solid economic backdrop, so there's no pressing need to cut rates to support the economy. So they can afford to take their time. And I think as inflation gradually comes down, there will be a case to cut rates. And in fact, if you were to just apply a simple policy rule, so just look at how the Fed has typically reacted over the past, it would suggest that the Fed would be cutting rates pretty rapidly at this time, that interest rates are too restrictive at the moment relative to what economic conditions demand. But Fed officials are using their discretion. They're very worried about inflation reaccelerating. They're mindful of the lessons of the 1970s and 1980s, where a shift towards looser interest rates too quickly allowed inflation to reaccelerate, and then it was much more damaging to get inflation back down again. So To avoid a repeat of that, the Fed are being much more careful. I think that calls for about 3 interest rate cuts this year, perhaps 1 a quarter. So they might cut interest rates, then wait a meeting. Then if all the trends were still pointing in the same way, I think they could then proceed for another cut. So we still have the Fed cutting interest rates for the first time in May. I think we'll hear from Fed Chair Powell in his testimony to Congress later this week that they intend to take a relatively gradual approach as well. And really, even though that would be historically abnormal, I think it would help get policy back to a more neutral setting, balancing the risks between allowing inflation to reaccelerate, but also limiting the downside risks to the economy if interest rates were left too high. So given that the outlook I've presented has been relatively solid for the overall economy, I wanted to spend a bit of time at the end of this presentation talking about some of the risks that I see to the outlook. And I think obviously that there's always risks in both directions. Really, some of the biggest risks that I'm paying attention to right now all lie on the supply side. So on the next slide, I show a couple of interesting factors that I think have been behind the strength of the US economy over the past few years. So I mentioned that a lot of the reduction in wage growth that we're seeing is being driven by a stronger supply side of the economy. So that's been critical because the stronger supply side means you can get stronger growth and falling inflation. That's good news for everyone. And really, I think there's risks in both directions here. On the positive, we've seen some substantial changes in the economy since the pandemic. Obviously, there was the big shift to working from home among a number of sectors. But perhaps more interestingly, for productivity, I would say that the most notable change has been the big increase in business formations in the US. So we've had a lot of new businesses being formed over the past few years. And really, this has been accompanied by a big surge in investment, particularly in software, in research and development on the US, by US businesses. Now, what we know about that is that can tend to be associated with increased productivity in the economy. And we've seen signs of that over the past few years. We've seen productivity growth rebound. It's running above its trend rate of 1.5% over the last year or so. So if we were really seeing signs of those investments early on in the pandemic, which have been sustained, and that increased business dynamism in the US economy really feeding through to higher productivity growth, that's something which I think could drive stronger growth in the US economy without adding to inflation. So the Fed could still cut interest rates, but growth could remain even stronger. I think that would be a good upside risk to the US economy over the next few years. And I think on the downside, obviously a lot of the improvement on the supply side has been in the labor market. And really what we see over the course of the pandemic is this big rebound, obviously first decline in immigration in the early stages of the pandemic because the US closed consulates around the world and travel was severely restricted. But once the country reopened, we saw this huge surge in immigration, which really was a big supply side boom to the labor markets. We've seen large numbers of foreign-born workers entering the labor force. That's contributed a lot of the growth of workers over this period. Now, the risk is that that's largely a one-off, and we already see signs that that's fading. Less support from the supply side in the labor market could make that trade-off much harder. So we could see a resilient economy associated with a re-acceleration in wage growth. Now, that would cause the Fed to be a lot more cautious in terms of the pace at which it cuts interest rates, and that would make me a lot more worried about the financial stability risks to the economy. I think if interest rates remained higher for longer, I think there's a lot of pockets of debt out there which would start to look more precarious, particularly linked to the commercial real estate. We've seen obviously the office sector, particularly where there's very large very high rates of vacancies. A lot of the refinancing and debt associated with those office buildings comes due in over the next few years. So the longer interest rates remain at these elevated rates, the much greater the risk is that there's a more negative outcome associated with refinancing that debt that drives a cycle of increased bankruptcies that leads to layoffs, that could lead to a downward spiral in the economy. So those are risks on both the upside and the downside that we're paying close attention to. But just to summarize, my last slide shows my key conclusions, which is that this year should still be a year of pretty solid growth in the economy. Even if growth is a bit weaker than we saw last year, we're still expecting growth of around 2%, so still pretty solid. Even against that solid backdrop, I think inflation has further declined. There's a bit more disinflation coming down the pipeline, and I think that will allow the Fed to gradually begin to lower interest rates. And like I said, the key questions, I think, to my mind, are all around the supply side of the economy. Can this improvement that we saw last year last? My base case is that some of that strength fades as some of that immigration story fades and some of the productivity boom begins to fade. But a repeat of that this year would be a significant upside risk to the economy. And on that cheery note, I'll leave it at that and hand it over to Brody.
All right, thanks, Michael. I appreciate it. All right, we're gonna move into some trends here as far as credit, commercial and consumer credit, how that's impacting across the market, just from the perspective of how we're personally doing with our own credit and how that impacts the businesses that we have. So one of the things about Experian that we do is our focus is really about bringing small businesses into the light. So there are a lot of small businesses out there. When we think about a business that you might start, your business might be just you in a room packing boxes or putting together code or getting out and being a consultant. Those are a lot of times businesses where commercial credit isn't quite used yet, and you're using your own personal credit. What we want to do as part of the initiative as we interact with the market is to provide that guidance for small business owners such as yourself or those that you're helping as part of your customer base to get into the commercial market, to be able to get a loan that's a commercial focused loan, to separate out their consumer and commercial profiles so that both the scores rise as you push utilization onto the right form and the right profile for you. So as we go forward, we're going to start with our commercial database, talk about the types of data that we have included in it. We're going to look at how the consumer is performing. We're going to bring that in as a guarantor of you, move into the commercial space and talk about how small businesses are being impacted at this point and where they really feel they're going. And if some of you have looked in your inbox lately, one of the things that I like to see is companies are giving me permission to spend. And as a consumer, I'm already out there spending. I spent through the holidays. Retail sales were up. We were up at 5.8% growth when we look out there. But now it's interesting to watch these emails or texts that are coming to and saying, hey, you have the green light, go spend. And I think that feeling is starting to permeate through the market that it's time to start going again. So let's go to the next slide. So as we think about where the consumer is, so let's look at that perspective. And Michael talked to some of this, but I want to add a little more context from a business owner perspective. So when we look at the consumer balance sheet, we still see that savings, it's down a little bit. We expect savings from an average on a consumer to be around 6%. We've been around the 3% mark for a little while. We'd really like to see that come up a little bit. That savings has gone down because consumers are spending into that to cover some of their behavior that we had seen over the past couple years coming out of the pandemic, and even down as we saw markets kind of heating up, consumers were spending a little bit more. We see wage growth, as Michael spoke to, continuing to be in an upward position. So you have people that have jobs, wages are keeping up with inflation. That means consumers are still out spending, and there are programs and safety nets in the US to keep the money flowing, and those cash flows are what small businesses are looking for, and that will really impact how they look at protect versus the grow strategy in the next year. Now, when we look at some of the change in consumers, a lot of times we've talked about in the past, well, it feels like consumers are running their savings, stimulus is running a little bit thinner. But over the past year or so, we've looked at the increase in disposable income. And that disposable income is what keeps a lot of these new small businesses in the market going. Those that are dependent on not just a core bill that the consumer has, a core debt obligation that they have, but really on something that is a want versus a need. So as we look at disposable income, what we've seen is a positive trend in that. And the expectation is that we'll see a positive trend going forward. That's a good thing for small businesses. As disposable income continues to be higher, that means consumers can continue to spend at the same rate that they've been spending in the past. And that's good when you're creating a strategy for the next couple years. Let's look at originations from a consumer perspective. When we look across, one of the things that we've talked about before is that originations have pulled back. That means loan products like mortgage, auto, unsecured debt, any type of credit cards, they've kind of pulled back a bit and leveled out. Now, some of that is because interest rates have gotten a little higher on some of these products. It's a little harder to go out and buy a car. If you're spending upwards of $1,000, $1,200 a month on a car payment, that gets expensive, especially if it's not in a luxury item. That's a lot of money to spend every month. And we've seen a lot of homeowners stay in their homes. So they've had a 3 or 4% interest rate on their home, on their mortgage, on their 30-year mortgage, and now they go out into the market and they see 7, 8, 9%, and even more in some cases. And so they're not willing to move away. That keeps debt obligation down. So if you're maintaining your 3 or 4% mortgage, you're gaining that. Michael talked about that a little bit more. You're putting a little bit more utilization into your unsecured debt. You can service that debt a little bit better because your wages are increasing, your mortgage shelter isn't increasing, but so you can put a little bit more toward unsecured debt spending behavior as you go forward. And so we'll see that continue over the next year. Now, we did see delinquencies go up, and that has some lenders concerned as they're watching this continue to rise. Delinquencies are rising as we break it down into income segments. Certainly the lower income segments are feeling a little bit more of the brunt. As Michael talked about, that's where some of the wage increases come in. For the most part, where people feel it the most is in the lower income ranges. But still, as prices have grown, we have seen delinquencies pick up, meeting those basic core bills, debt obligations during the month has become a little bit harder. And so we do see in some of those segments an increase in delinquencies. Now, one of the things that we've talked about before is how are credit scores faring. So if you have a credit score that's been on the rise, and we've seen shifts in credit scores going upward, we've seen standard generic scores up around 714, 715 as an average score out there in the market. The expectation is for those to start coming back down as stimulus wore out. We see delinquencies rising. Now, those delinquencies are rising in the lower income segments and lower score segments across the population. And what that means is if you're starting at a lower score, so if you're in the 500, 600 score bands, you miss a payment, your score doesn't come down very much. So it's not bringing the overall average score down, but we are seeing if you're at an 800 right now score, which is fantastic, congratulations for you, and you miss a payment, your score can come down as many as 120 points. When we start seeing that impact on higher score levels, that's where you'll see the average score begin to come down across all the tiers. But we're not seeing that, and the expectation is we're really not going to see that over the next year as wages, again, keep up above inflation. So let's go to the next slide. So as we look at what we're seeing from a banking perspective, so tightening is certainly there. So if we see delinquency go up, we see banks tighten down. Some of you may be looking at your underwriting practices or even your portfolio management practices. From a consumer side, the sentiment has been to tighten, 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 but we've seen that taper off across all products, where as we're surveying, we see the SLOOS report as they survey lenders, there has been more of a positive attitude toward lending over this next year. Consumers continue to spend, continue to keep up with their debt obligation, and that means they can loosen some of that criteria. And for some lenders, this is the FOMO time, fear of missing out. You have consumers that are performing well, a market that's pretty warm still. Is this the time to pull back even tighter, or is it time to open up and look for opportunities across some of those segments, some of those tiers where you've seen people drop maybe 1 or 2 points in their credit score and they've dropped, they're really close to your tier cutoffs? Might be an opportunity again to review that underwriting criteria, and we're seeing a lot of our lenders do that. Now, as we look at commercial scores and tightening, we've seen that as well, a tightening within the market for commercial lending, and that's again across all products. That's going to impact the number of originations that we see out there. As tighten up underwriting, that really comes in kind of perpetuity to our commercial or consumer tightening. So commercial is going to tighten down a little bit more if there's some worry about cash flows, or you look in certain industry segments and you see the delinquency levels start to rise, then lenders will start to pull back a bit. It is a pretty crowded market right now for commercial lending. That means you have your large financial institutions that cover a lot of the bulk of the population that's out there seeking these type of loans, but there's also a lot of fintech lenders. So if you're not getting a loan at the first, you have the capability to get in second, third tier and pick up a loan. Now, maybe not at the terms that you expected at the very beginning or what you're used to as a small business owner, but it is still possible to get a loan out there and to continue moving forward with your business. Now, banks have been pulling back a little bit as we've had this narrative of recession over the past year, 2 years. We've seen banks, as they were in a good environment, heating up economy, they had opened up their underwriting criteria, they took on a lot of asset debt. They've taken on a lot of assets. And so what we've seen over the past year or so is that those assets, they pulled back, they've tightened their criteria, they're pulling back. And you can certainly see that here in the purple bars on the right hand of the slide, shrinking down a bit. That means they're not taking on as much commercial debt in their lending, slowing it down, thinking they were going into a more focused, heavily weighted slowdown in the market and into a potential soft landing or a light recessionary timeframe, so they pulled back. Now we should see this trend bounce back up. Assets begin to, again, accumulate at lenders as they go forward and begin to open up lending a little bit more. So as we go into the next slide, what we're going to look at as we follow through into the types, we talked about that commercial lending shrinking a bit, and our expectation is to see it open up a little bit more. Michael talked about this a little bit. When we think about commercial real estate, we've seen prices kind of go up and then they've dropped off. And they dropped off because we saw that buildings, we didn't have that rush to go back to work. We saw prices begin to drop because buildings were empty, leases were not renewed. There were some lease extensions that were given to companies, but as they saw, there wasn't a potential, those leases were canceled, and ones that wanted to keep their building or their space, they tried to extend terms, and extending terms that were at those lower rates. Some of our property owners in the US have said, that's enough, you need to re-up, we need to get you at a rate that's more appropriate for the time, and that would put them a lot of times at a significantly higher rate. That puts them upside down. That creates opportunities for some volatility within the commercial real estate market. And as we mentioned before, as we look to the right-hand side of the slide, you'll see that there is some exposure in the commercial real estate space where you're going to have commercial real estate kind of upside down, where there will be some volatility, certainly as we look across MSAs. When we see some slowdown here, you'll have more inventory entering the market. That's going to impact some of our construction companies. As we look for growth in those or delinquency levels going forward, you won't see that expansion of growth that we might have expected in a different market environment. I think we'll see just a little bit of tempered downward pressure on the construction industry as we get into the next couple of years. All right, so as we move forward, we're going to look a bit more at commercial credit. All right, let's go to the next slide. So when we think about commercial credit, we have to think about the environment. And what we've seen is small business applications, so these are new businesses coming into the market, have stayed really elevated in the US. We've been about 400,000, maybe even a little bit more every month of applications coming in. Now, when we look at what's a real application, the high propensity to become a real business, you're still around the 100,000 mark. And that 100,000 mark are ones that will really survive. And that's every month coming out. New businesses, 100,000 a month. Now, why we see not as many in that high propensity bucket is you have a lot of online retail that are opening up. We see a lot of construction that's opening up, and sometimes those cycle through a little faster fail rate as they go forward. But a lot of those are staying in business a lot longer because of the stimulus that was in the market, and because consumers like you and me have been given the green light to continue to spend. And if we're given the green light to continue to spend with disposable income, these fringe players can stay in business a little bit longer. And you can see it in the big bar chart, that we still have around 35% of the overall portfolio of those that are credit active are businesses that have been just in business less than a year. So a substantial portion of those seeking credit are still very young. And for a lot of us, for a lot of the lenders in the market, 24 months is the time frame that you really look at to start considering a small business. Over the past 2 or 3 years, we've talked about kind of shrinking that down to about 12 months for a review. That's gotten a lot more of the larger lenders with some different credit terms, different products into this space. A little bit more risky. Again, you're in with newer businesses that don't have a lot of history. But when you're combining the guarantor with the commercial payment information, the financials over that 12-month period, you get a pretty good sense of how the business will perform going forward. And we've seen those survival rates increase as we've gone through the past couple of years. So that's really been a positive point in the current market and our current small business environment. All right, so let's go to the next slide. So we're going to talk about lending. So when we think about the commercial lending space, we're going to look first at credit cards, unsecured debt. It's what a lot of small businesses use at the very beginning. You may start with your own card, your personal credit card, and you're pushing it through, and your debts are building, your utilization is building. And what happens with your credit score when your utilization gets up above 33%? Score starts going down. So we want to be very careful about that. And that's really one of our main drivers here, is to help consumers who are business owners to separate out that consumer and commercial credit and help to raise them both. And as we look at commercial performance, we see that originations have been pretty stable. They are pulling back a little bit in the past year or so, and that's with that tightening that we've seen across the market. Remember when we talked about that there's still some second tier, third tier players that are out there, fintechs that are filling in a lot of the gaps, where we see small business owners maybe not get the terms that they want at the original lender that they're used to, or where their deposits account is. They move out to secondary or third tier lenders, and they can pick up credit. And that keeps the overall view of the market and originations still in the positive, not dropping as much. There's still access to credit. Now, we do see from an unsecured debt perspective that we see delinquencies still on the rise, and they are going in the upward position. Still pretty close from 30 to 60, 60 to 90 range. Most credit card lenders look at about 60 days past due as their real demarcation to good account versus a bad account. But we've seen that be pretty close, not a lot of roll from 60 or from 30 to 60, 60 to 90. So that's good to see. We have seen them elevate just a little bit. Now, when we look at term loans, so think about what's happening in the market right now. You have fees that are going away. You have some challenges to what's happening in the card space. That's going to increase lenders' need to cover costs, and a lot of times they'll do that by either raising rates that we see or limiting their exposure from what they're willing to lend. From an unsecured perspective, when we look at credit cards, if you have a credit card and you're a small business owner, that's generally the first loan that you have. If your APR goes from 5 or 6%, which it was a couple years ago, now you're up to over 30% from an APR perspective. It may be more advantageous for you not to roll or cycle that debt over and over on a credit card. You might look for a longer term, a term loan at a much lower rate, and you can get those around 9–10%. So what the expectation is if we continue to see this push of cards in the commercial space and an increase in the rate that's being charged for the debt that's revolving, we'll see more and more small business owners look for opportunity to go into a line of credit or some longer term facility. So we're going to watch for that over the next couple months. All right, let's go to the next slide. So we are seeing delinquencies on the rise, but just slight. Now, when we look across all the industries, a lot of you have asked questions, well, how does this happen? Is this one of those, we talked about a K-shaped recovery when we looked from a pandemic perspective. We've come into this place where the economy is still pretty warm, cash flows are still pretty good. How is it impacting across industries? Now, when we look and we closed out 2023, what we can see here year over year is that it looks across all industries that we haven't seen an increase in delinquencies year over year. Now, where are some of the challenging areas that we had seen over the past year as we go back to some of those other quarterly reports that we looked at? We saw it certainly in the supply chain when we had challenges getting out into the market, being able to deliver into the US, and trucking companies certainly had a challenge getting product at a reduced volume of products because interest rates were so high or inflation was so high that the cost of products made the volume of it shrink, even though consumers were spending the same. Temu packages are much smaller than a box from Amazon. And so when you're looking at that brand reduction, you're looking for opportunities to save as a consumer. There's less in the back of a truck, and that means less trucks are needed. So we did see that transportation process hit some volatility mid last year. Now, when we looked toward the end of the year and we closed out, we had good retail numbers. We looked at supply chains fairly open. There were some challenges, certainly across the world, but those have been, we've had some mitigation activities that have occurred that have kept it up. We've seen in general, year over year, that it looks pretty good. Now, we're going to continue to track that as we get into the end of the first quarter. And as we've seen some warming effect here, and we've seen some continued spend that's pretty good from consumers, we may even see some improvement across some industries as we go forward. And that's going to add a little heat. So as we look to our economy and we look to some of the decisions in the Fed, as they see some of the heat being added to our economic environment, that may cause them to hold a little bit longer. And we're going to continue to watch that. Let's go to the next slide. So when we think about delinquency rates, what comes next? Well, bankruptcy. For a lot of customers, that thought of bankruptcy crosses your mind. Do I have debt that's outstanding, or having a real challenge here covering the costs that are there? Am I really repaying and doing right by my suppliers? Now, when we look at the bankruptcy rates, they have been coming up over the past couple quarters, but they're not really coming up very fast. We think about the small businesses that are out there, and you'd say, oh, small business churn is happening. We have 400,000 applications a month, 100,000 that are turning into real businesses. Why aren't they filing for bankruptcy if they're going out of business and churning a bit on the fringes? Well, it's because in a small business environment, you're not going to see as many file for bankruptcy. If they're keeping up and they can see that the cash flows are slowing on the types of products that they're selling, they may just close their doors. We saw a lot of that during the pandemic. We've seen it during other segments of slowdown within the economy. They just close their doors. And so in the end, bankruptcies aren't going up at the same speed. Now that the economy is warming a bit, we're going to see those even moderate even more as we go forward. So we're going to continue to watch this trend as well, just as an indicator of, how businesses are feeling. And of course, how businesses have grown from that 1 year to 2, 3, 4, 5, where they feel more stable as a business. Then you'll start to see more bankruptcies hit in this really formal version of closure. All right, let's go to the next slide. So when we think about small businesses for the next year, how do they feel? Are they encouraged to grow? We have this environment around them where consumers are continuing to spend. We may get some additional stimulus or easing some support for consumers as we go into this election year. Sometimes that happens with policies. As you bring it up a little bit, everybody raises up, gets excited for a new year. We may see small businesses look out and say, all right, this is the time for me to start my capital expenditures, to look out at what I can do to grow over the next year. We've seen the sentiment certainly begin to rise. Now, it's not like we said earlier, they're not getting the text message to say, hey, it's green, let's go. Let's start expanding and do it quickly. I think there's still pressures in how small businesses are feeling as far as their access to funding. Remember, rates are still high, costs are still high. They're coming down, but they're still high. Labor costs still elevated for those that have employees. And so there is that pressure on small businesses to really think about, is this the right time to go? Do I have the green light to move forward? And I think that it's good to see that sentiment increase. That means there's building anticipation that it's really time to move forward. All right, let's go to the next slide. So I want to talk a little bit about what we see from and continue that sentiment discussion. So we have seen consumer sentiment improve. That's really good. You see a pretty good spike here as we go forward. So feeling good that there's not going to be a recession. Wages have stayed up. Quits have come down a little bit, but jobs are still available out there for the general public and for our labor force. That means that they'll continue to spend. That means they're feeling pretty good. Now, I didn't include that for small businesses. That's the purple line on the left on the top. Improving. So over this last month, we even saw an improvement from a small business perspective, and they're more encouraged as they see cash flow and they get ready for a potential warming in the economy over the next year. So very positive feel. Now, does that make the Fed feel good? No, like Michael said before, again, we look at the forecast for rates. Where do we see the positives? Well, the expectation again is in summertime, we should see the Fed begin to look at rate cuts. We'll see about quarter point pullbacks, some rate reductions there throughout the end of the year. The expectation is about 75 basis points, probably making a cut, skipping a meeting, making a cut, skipping a meeting as we go forward. Again, a slow move into that. It's not gonna be a super boom, it'll be a mini boom. You'll see some refinancing with small businesses that are under a year old that are working in the construction industry or that are looking at building buildings or assets or residential properties that have been holding a little bit longer under construction loans at a little higher rates, looking to revert out, refinance some of their debt, move it into lower cost. They're not going to see that big of a rate reduction as they look out for those types of loan products. And so as we start to see a little bit of movement there, you'll start to see small business owners and even consumers re-enter the market and look for reapply opportunities, certainly on some variable rate products that they currently have on book. So we'll see a little bit of that begin. We'll see a lot more of that in the first part of 2025, and we see a little bit more of a drop early in the year. But I think that's, as we're looking forward, it'll be a slow, steady move toward rate reductions as we go forward this year. We will see a warming economy, but that's still a positive. We're still keeping it at a very steady pace from a small business and consumer perspective. So let's wrap it up. Let's go to the next slide. So as we kind of think about where we're at, and Michael covered some of this as well, I think we're at, again, a pretty steady reduction from Federal Reserve perspective. We will see some surge in productivity. Our labor force is still going to be pretty strong. We'll see wage growth continue at a tempered pace. Utilization on consumer debt will continue to increase. We're going to see, even though wages are going to be increasing, they're going to be increasing that much. So we'll continue to see consumers spend and put more on their unsecured debt as we go forward. Still at a pretty good pace. A lot of that debt is still under 33% utilized on their cards, so still in the place where they can spend, have some capacity or ability to repay that debt and not bring down scores at all. So that's a very positive point into the next year. The expectation is that we'll see some slow, steady growth across the economy. So not the blowout year that we would all like to see, certainly from a lending perspective, but a slow, steady growth, a warming of the economy. The Fed's slow to reduce rates, and so we should see just some positive movement this year. So we're very excited to see that as we go forward, and great to not hear that R word come out anymore across economists, where we pull back and we say, hey, there's no need to say recession at this point. We really are feeling the warmth of a growing economy. So looking forward to that. All right, so we'll kind of close it out here. Gary, do we have any questions that have come through in our chat?
You guys had them riveted today. There are no questions. And I see that we've only left about 4 minutes on the clock. So we're going to give some time back to everybody today. I want to thank everybody for attending. We greatly appreciate your feedback before you go, though. We've got an exit survey on the way out, and they really do help us just format these webinars to your liking and cover the things that you want us to cover. So please take a moment when you exit to fill out that survey. And we want to thank Michael from Oxford Economics. Thanks for all of your hard work on this report, Michael, and for coming here to do the quarterly webinar with us. Really appreciate it. You can find all of that information from Oxford Economics over there on oxfordeconomics.com. And Experian Business Information Services, we are at experian.com/B2B. And with that, we will draw today's webinar to a close. Have a good day, everybody.
Thank you.